Hello, my CFA friends. How are you, my friends? So, I've been posting a bunch of videos for you to watch passively, right? But I've also been thinking about ways in which I can involve you guys as much as possible in this channel and to make it more interactive. Enter AMA sessions. Now, for the uninitiated, that stands for Ask Me Anything. So I'm going to be starting this series here where you guys can post your own questions. So I've got some ideas for you about things you can be asking me. Obviously, that's a CFA level 1 Ask Me Anything. So the obvious elephant in the room is we've got a bunch of tuition videos. Now I know people have been leaving comments under the videos, but it's sometimes nice for everybody to get an answer rather than just an individual. So if there's anything that's not clear in the videos, you can basically ask me to explain it in another way or expound on certain elements in the video. So that's one idea we could be looking at. Another idea is strategic and tactical exam prep questions. What that means is you might be just starting your studies. Now, I know a cohort is just finishing, another cohort is starting. So you might be thinking, how do I study for this thing? How many hours should I be putting in? What kind of hours should I be putting in? What's the percentage of question practice versus reading? What I should be reading first, what I should be reading last. Sky's the limit to what you could be asking me. Tactical questions, right? Strategy is your long-term prep. Tactics is your day-to-day operations. And then obviously some people might be asking me about the actual exam day, what to do, what not to do, what to bring, what not to bring. So these are just ideas. Also, tricky concepts. Now, you might be reading the book. You might have come across, I don't know, modified duration. You don't understand it. You want to ask about it. And you want a human to answer that face to face. Somebody who can answer your question, my friends. That'll be me. And obviously calculations as well. If you're posting any calculations, you're going to want to basically show me the question and the solution so I can have a look at both and see if I can find a better way of solving that problem. Also, commentary on real-world events. And today we are going to see a question on the recent debacle with the yen carry trade, right? So I am not limiting myself here just to CFA level 1. I'm more than happy to comment on the real world as well. Obviously, we are preparing to be financial analysts, portfolio managers, investment bankers, risk managers. We're going to be working, you guessed it, in the real world. So we need to have an opinion on the real world. So here is our real world question of the day. This comes from Dan. Dan is a friend of the channel. So thank you very much, Dan, for supporting the channel. So here's what Dan is asking. I was hoping to get more information on the yen carry trade that caused so much disruption earlier this month. I understand the concept of borrowing in yen and investing in other assets, but I'm confused on some of the mechanics. How do currencies have yields, for example? Okay, so we're going to actually answer all this in great detail. I'm going to show you first the computation of what a yen carry trade might look like so everybody can understand the mechanics. And then I'm going to go and look at what actually happened in July and early August with the yen carry trade. Before we start, let's just address this issue of how can currencies have yield. So yield is just another name for interest rate, Dan. So basically the yen will have its own interest rate and let's say the US dollar will have its own interest rate. So when you invest in a certain currency, you are obviously getting interest income, and that could be referred to as the yield. So think of a dividend yield. If you bought a stock, you'll be getting a dividend and an associated dividend yield, therefore. So if you invested in a certain currency, let's say you converted your money to, I'm not actually sure where Dan is located, but let's say you converted your money to pounds and stick it in a UK bank account, savings account, then obviously you're going to be getting interest income. And that'll be referred to as the yield on the pound. Okay, before we actually look at what happened recently, let's go through a very basic carry trade example. So just before we start, big picture, what is a carry trade? Carry trade is where the trader borrows in one currency and then converts to another currency and lends in the other currency. And the idea is that the borrowing currency's rate is very, very low compared to the lending currency's rate. So the trader is hoping to keep a differential, an interest rate differential there, obviously assuming that exchange rates are not going to move. And historically, the carry trade has been a yen carry trade because, as you know, Japan has historically kept its interest rates close to zero, right? We know Japan is very indebted. We know that they've been sort of fighting deflation, so they've had historically very, very low interest rates close to zero. And of course, before the GFC, before the QE madness began, interest rates were much higher elsewhere, so the carry trade has been going on for decades. And now, obviously, with currently high interest rates in the rest of the world, the carry trade is obviously pretty hot at the moment as well. But let's look at the example here. So in this example, Dan, after watching today's video, has become so excited that he's changed his job to become a carry trader. Hopefully, don't do that, Dan. But Dan is a carry trader in this example. He borrows 1 million JPY, Japanese yen, of course, at 0.1%. I told you, it's yielding very little. So that's the interest rate at which he borrows the Japanese yen, converts at USD JPY of 160. Now, be careful here. I'm using the official ticker for the currency pair. This is not how the Institute quotes the pair. So if you were doing an Institute question, it would have been quoted as JPY/USD, i.e. it will say JPY units per 1 unit of USD. But the Institute simply doesn't quote them the way the markets quote them. So I'm going to give you the market quotation. So in the market quotation, the first 3 letters of the ticker represent the base currency, i.e. the 1 unit, and the second 3 letters represent the price currency, i.e. the numerator. So in this case, we are saying that if we take 160 yen, we could buy basically $1. Okay, so I think at some point in July, mid-July, we had hit that exchange rate of $1, purchasing 160 yen. So the yen was kind of crashing at that time before then reversing and rallying. So back to the question, Dan borrowed yen, okay, 1 million, then converts it to US Treasuries at 160 yen per dollar, and then invests at 5% in US Treasuries. So there's the carry trade here. The differential determines the profit. And now in scenario 1, a year later, the exchange rate is unchanged, and this is a dream scenario for Dan. A carry trader hopes that the exchange rate will either flatline or indeed will move in his favor because he's going to be holding dollars. He's hoping that either the exchange rate flatlines or the dollar appreciates, which will give him additional profit. But let's say the exchange rate simply flatlines. Then Dan has the differential here of 5 minus 0.1, and that's going to give me 4.9%. 4.9%. So that's a quick and dirty calculation, but let's just do it from first principles. So I borrow 1 million JPY, let's write that, JPY at 0.1%. Well, let's see what that's going to be worth, first of all, in a year's time. So I've taken the principal, I've compounded it at 1 plus 0.1%, and I've got the future value of the loan, which is 1,001,000 yen. Now, at time 0, again, what I did is I converted 1 million JPY to USD. Okay, and when I do that, obviously the dollar is stronger. So intuitively, what I'm doing is I'm taking 1 million and dividing it by 160. And now I have $6,250. Okay, so I'm going to lend the $6,250 for 1 year at 5%. And that's going to give me 6562.5, 6562.5. Again, that's in dollars. And finally, I will need to convert that back to a Japanese yen. So I take 6562.5 and I'm multiplying that by 160. Remember here that the exchange rate did not move, so that's going to give me now 1,050,000 Japanese yen. So if I take now the future value of the Japanese yen and I subtract the future value of the loan, I can see here that my profit will be 49,000 JPY. That's in JPY. And if I want to calculate this as a percentage, I can simply take 49K over 1 million, and I will know that's 4.9%. Now, I didn't have to go through all these hoops and hurdles because all I had to do is, assuming that the exchange rate wasn't changed, I could just say, well, take 5% and subtract 0.1%, and that'll give me 4.9%. So that's where the profit is coming from, Dan. But obviously, if the exchange rate moves against us, then we are going to be losing money, which will be scenario 2, where the USD JPY crashes to 140. Now, what that means is the dollar is depreciating and the Japanese yen is appreciating. Okay, the Japanese yen is appreciating. So when the Japanese yen is appreciating, that's going to be a problem for us, because when we are unwinding our trade, remember, we have to end up with Japanese yen, but now the yen is more expensive. So it's resulting in us having fewer yen to repay our loan. Okay, in scenario 2, we begin in the same fashion. We borrow 1 million JPY at 0.1%. Well, that's got a future value of 1,001,000 yen. Then I'm converting the 1 million yen today, again at 160. That's giving me the same value in dollars today, which is 6,250. Again, I'm lending that at 5%. That's the future value. Same thing up to this point. The only thing that changes now is at the end of the year, I'm going to convert my dollars back to yen at a much lower rate of 140. So notice here now I have less money than what I need to pay back. So my profit is actually negative 82,250, or in percentage terms, that is negative 8%. So what's actually happened here, just quick and dirty to think about it, is you can say, well, the profit in percentage can be given by the interest rate in the US currency minus the yield on the Japanese yen. So that's going to give me 4.9% plus or minus the return of the FX. Okay, so now this is a quick and dirty calculation, not an exact one. But if I just look at the return of the FX, i.e. the return of the Japanese yen, holding period return P1 over P0, so 140 over 160, take away 1. Let's quickly do that. And we are getting 12.5%, negative 12.5%. So in other words, here we are subtracting 12.5%. So what do I get? 4.9 minus 12.5. I'm getting negative 7.6. Again, that is an approximate solution. Yeah, so it doesn't, include compounding and whatnot. But obviously, it's showing you that interest rate differential can very, very quickly be eaten away by an appreciating Japanese yen. And Japanese yen tends to appreciate during times of trouble. So if markets panic, as you saw, if people try to unwind their positions and flee back to yen, then the yen will appreciate. Okay, then, so what actually happened? Why did this panic ensue in the first place? Well, BOJ, which of course stands for the Bank of Japan, so this is the central bank in Japan, just like in America it would be the Federal Reserve, which we lovingly call the Fed, or in the UK it will be the BOE, the Bank of England. So their central bank unexpectedly, and this is a very key word, the markets did not expect that, the markets were surprised, but the BOJ unexpectedly increased rates from next to nothing, or 0.1%, to something that's next to nothing again, 0.25%. But again, the jump percentage-wise, I guess, interest rates have more than doubled here. And the key point was it was unexpected. So I think that happened around the end of July. And of course, this surprise spooked markets, and therefore traders started closing their positions. Now, what these traders do is they borrow yen very, very cheaply, and then they obviously invest in higher yielding assets. So what is a higher yielding asset? Well, it's got to be a risk asset. So not surprisingly, things like the NASDAQ, which is very tech heavy. It's not only technology stocks, but it is pretty tech heavy compared to, let's say, the S&P or the Dow Jones, or NASDAQ experienced a drop of 10%. 10% is a significant drop for stock markets, my friends. The Nikkei 225, which is the Japanese stock market index, was actually down 20%, which was the worst day since Black Monday of 1987. Yeah, that goes back quite a few years. But if any of you were around, or if any of you are, students of history, you'd know that Black Monday 1987 wasn't a happy day for traders because markets dropped, you guessed it, about 20+%. So that was a pretty big black swan for the Japanese stock market. BTC USD, which is obviously the ticker for Bitcoin. Bitcoin was down 30%, my friends. Again, think risk assets were down. And as I was saying earlier, the Japanese yen, which had been crashing in July, so it was trading at 160 yen per dollar, then rallied back to 141 per dollar. So remember here, the yen strengthened, and it had started strengthening already before this debacle. It had started strengthening ever since mid-July. The BOJ decision was at the end of July. So already that may have caused some traders to start unwinding as they saw that their trades were becoming unprofitable. Also remember, when you do a carry trade, you're using immense amount of leverage typically. Some traders do. And so you can sort of get in trouble pretty quickly when the trade moves against you. If you don't have enough liquidity in that trade, if you don't have enough margin in that trade. So I guess, what was the drop here? It was more than 10%, wasn't it? It was probably 11-12% drop. The drop in the dollar, the worst was on the 5th of August. That's, I guess, when markets hit their trough, and then there was sort of a V-shaped recovery when everybody realized that life simply goes on. So paper hands, I guess, sold on the 5th of August to only see that markets completely recovered, and maybe some of them then went back into the market and bought at higher prices. So don't do that. Don't be that guy who sells at the bottom and buys at the top. Don't panic easily, my friends. Be firm in your convictions. But yeah, that's pretty much what happened. I hope we've covered most of it. Now, Dan is a friend of the channel, and there's really no reason why you shouldn't be a friend of the channel either. If you guys are a CFA level 1 candidate, if you are watching tens of hours of these videos, please support the channel, and you actually also get something in return, which is my question-based revision. You can do that at www.stoianov.co.uk/revision. I cannot operate this channel without widespread support. I've priced the product so cheaply that no matter where you're located in the world, you should be able to support the channel. And I cannot operate this channel without your support, my friends, without your widespread support. So submit your questions to stoianov.financial@gmail.com. I will be prioritizing questions from friends of the channel, and I shall see you in the next AMA session. Until then, have a great day.